This is section 4-3, automobile insurance. The quote is, "Never lend your car to anyone to whom you have given birth." This is Irma Bombeck, a noted humorist. And basically it's saying a parent should never lend their car to the child, which may or may not be appropriate. I don't know. You may not agree with that. Anyway, the objectives are to identify the different types of auto insurance coverage, compute insurance costs, and compute payments on insurance claims. Okay, there's not a lot of math or heavy-duty math in this, but there's a lot of definitions. So here we go with the key terms. There's a lot of them. There's a couple pages worth of them. First is claim. This is a request for payment from an insurance company by a policyholder. Okay, when you make a claim, you want the insurance company to pay for something which you're supposedly covered for. Now, here we go into the different types of insurance. First is liability insurance, okay? This protects you if your driving causes injury to others or to others' property, okay? So this protects you when you're driving if you cause injury to somebody else or to their property, okay? Next is bodily injury liability, sometimes referred to as BI. This covers, guess what? Bodily injury. So these are the different options that you have within your auto insurance. You don't just have a blanket policy. You have different parts of it, and they cover different things. So bodily injury covers bodily injury. All right, the next, property damage liability, often referred to as PD. This pays for damage you cause to other people's property. Okay, so let's say you lose control of your car and you crash into somebody's house. You cause damage to their property, okay? Or you drive and you lose control and you hit a parked car. That's damaging somebody else's property. This is the type of insurance that would cover that. Next is uninsured or underinsured motorist protection, sometimes referred to as UMP. This pays for injuries to you and your passengers caused by somebody else, another driver, who has no insurance or does not have enough liability insurance to cover your medical losses, okay? So if you're driving along and somebody hits you, all right, and it's their fault, okay? If they don't have insurance to cover damage to your car or injuries to you or your passengers, this type of insurance would cover it if their insurance does not cover that. In Massachusetts, everybody's required to have insurance, so there would be no uninsured motorists unless they're from another state. Okay, next, personal injury protection, PIP. This pays for any physical injuries you or your passengers sustain while in, on, around, or under the vehicle, even if you are not involved in a traffic accident. Okay, so if something happens and you or your passengers get injured in or on your car, and this covers the protects against physical injuries, pays for any physical injuries you or your passengers have. The next is no-fault insurance. This compensates you regardless of who is at fault, okay? No-fault insurance, you could be at fault, somebody else could be at fault, it doesn't matter. This insurance is going to cover you regardless, okay? So let's move on to some more terms. All right, the first of these is comprehensive insurance. This covers the repair or replacement of parts of your car damaged by vandalism, fire, flood, wind, earthquakes, falling objects, riots, hail, damage from trees, and other disasters. It also covers your car if it is stolen, okay? So this basically covers repair or replacement of your vehicle damaged by means other than a typical accident, okay? It covers you whether your car is stolen and these various other cases, all right? Now, this is one of the types of insurance, however, that is fairly expensive and really only pays if your car is relatively new. If you have an older car, it probably does not pay to carry this insurance. All right, another example here of a similar type insurance is collision insurance. This pays for the repair or replacement of your car if it's damaged in a collision with another vehicle or object, or if it overturns, no matter who is at fault, okay? So you might think of this as no fault. But now, if you have a loan on your car, a lot of times the lender will require that you carry collision insurance. If, however, your car is older and has limited value, then it does not pay to carry collision insurance, again, because of the fact that it is fairly expensive. Next is car rental insurance. This pays you for part of the cost of a rented car if your car is disabled because of a collision or comprehensive covered repair. So if you need to get a rental car because your car is in the shop, this would cover part of that expense. Next, emergency road service insurance. This pays for towing or road service when your car is disabled. Okay, you break down and your car has to be towed. Or you're in an accident and your car has to be towed. This would take and pay for that towing. Next is surcharge. This is an extra fee paid to an insurance company for dividing an annual premium into monthly, quarterly, or semi-annual payments. Let's say you don't want to pay or don't have the ability to pay the full year's insurance bill up front. You can say, okay, I want to pay it quarterly every 3 months. Then the insurance company would add a surcharge to you for taking and doing it that way. It's just a service charge, if you will. And then lastly is deductible. This is the amount the policyholder must pay before the insurance company pays any money. Oftentimes on collision insurance, you'll have a deductible. You have to pay the first $500, they'll pay everything else, okay? Obviously, the smaller the deductible, the more the insurance company's on the hook for, so the higher the rate that's going to be. The higher the deductible, the lower the rate is going to be. All right, let's look at a few examples. Kwan's annual premium is $1,284. If he pays quarterly, that's 4 times a year, there is a $1 per payment surcharge, extra fee. What is the quarterly payment? All right, the first thing we're going to do is take his total premium and divide by 4 to figure out how much he owes every month, every quarter, if you will. So that comes out to be $321. Now, he's charged a $1 per payment surcharge or extra fee. So that $321 every 3 months, he has to pay an extra $1. So his quarterly payment is going to be $322. Stan has $25,000 worth of property damage liability insurance. He caused an accident that damaged a $2,000 fire hydrant, never knew they were that expensive, and did $5,600 worth of damage to another car. How much of the damage must Stan pay? All right, so $2,000 for the fire hydrant, $5,600 damage to another car. The total damage, the bill for the total damage is $7,600. Now, he's got $25,000 worth of property damage liability insurance. Since the $7,600 is less than the $25,000, Stan is going to pay nothing. Let's look at another example. Peter has $1,000 deductible collision insurance. Remember we talked about the deductible, okay? This is the amount that you are responsible for. Anything above the deductible, then the insurance company is responsible for. Okay, so he has a $1,000 deductible collision. Peter backs his car into his garage and causes $4,300 worth of damage to the car. How much will his insurance company have to pay? Well, he's got a $1,000 deductible. That means he's responsible for $1,000. So $4,300 worth of damage minus his deductible of $1,000. That means the insurance company is going to pay $3,300. But Peter is going to have to pay $1,000, okay? So the insurance company pays that at $3,300. He pays $1,000. All right, Bob has an auto accident caused by his negligence. He's at fault. He has $100,300 bodily injury insurance. The 3 people injured in the accident sued. One person was awarded $140,000, and the other 2 were awarded $75,000. How much does the insurance company pay? All right. Now, the $100,300 insurance means it's $100,000 per person, $300,000 per accident. All right. The first person who was awarded $140,000, the company's only going to pay $100,000 to that person because of the fact that this is 100-300. So for per person, it's only 100, and per accident, it's 300. So let's see how the 300 comes into effect. Now, the other 2 were awarded $75,000 each. So the company will pay $75,000 to each of the other 2 since their award was less than $100,000. $100,000 per person. First person gets $100,000. The next 2 get $75,000 since that's less than $100,000. So what does that come out to be? The $100,000 plus 75 comes out to be $250,000. The company's going to pay this full $250,000 since it's less than the $300,000 per accident. All right? Remember, it's $100,000 per person, $300,000 per accident. So the company will pay the $250,000. However, Bob is going to be responsible for the $40,000 that was not paid to that first person who was awarded $140,000. So he's responsible for that $40,000. The insurance company will pay the remaining $250,000. All right, the last example. Rodrigo has a policy with $50,150 bodily injury, $50,000 PD, and $50,000 PIP. He causes an accident in which he hurts 7 people in a minivan and 4 people in his own car, including himself. The 11 people who are hurt have minor injuries, okay, and do not sue. The total medical bill for all involved is $53,233. How much does the insurance company pay? Well, let's look at this. PIP, notice, is $50,000. What does that mean? That means $50,000 per person, per accident, regardless of who is at fault, okay? So $50,000 per person, per accident. As a result, the insurance company pays the entire $53,233, provided no one individual has bills over $50,000. That $50,000, again, is per person, all right? So long as no individual has anything over $50,000, the insurance company will pay the full $53,233. Now, as you can see, the math here isn't all that difficult. However, understanding these terms is. So make sure you go back and look at the definitions of all these terms and understand them.